And so that's the power of getting a higher rate of return. And we've done podcasts on that. Is if you can increase the rate of return, then you reduce the amount of money you need to live the lifestyle that you want, which allows you to quit whatever job you don't like sooner.
Welcome back to How to Invest in Commercial Real Estate, and we are back with another super exciting episode on evaluating commercial real estate. But before we get into the fun stuff, interest rates just got a lot more expensive, didn't they, boys?
Yeah, quarter of a point.
Not a lot more expensive, but it was in line with expectation.
My expectation was not in line with raise.
You wanted to decrease?
I'm optimistic, you know what I mean?
Actually, it was met with a lot of optimism.
And the 10-year, as a result, came down under 3.5, which is over a point down from its high.
So we say that, but I don't find a lot of people that land over the 10-year. I mean, it's not necessarily a common practice.
Well, like Fannie, Freddie, and most non-recourse debt do loan on the 10-year.
Okay.
But also the 10-year coming down most likely means the 5-year came down, and a lot of our 5-year retail loans are based on that index.
Okay.
So, 225 over the 5-year, let's say Chris Myers is an example at Stride or wherever he works now, that would be a metric he would use.
Yeah. So,
if 5 years 275, then I don't know what it is today. And you got 225 over, you're at 5% rate. So we're getting down into reasonable.
Yeah. And I just want to, remind people that if you're getting debt, at a quarter over prime is a reasonable average. So what is that? 8% now? So that means to get neutral leverage, you've got to buy an 8 cap to get absolutely neutral leverage. And
yeah, I mean, if I wouldn't be getting debt at a quarter plus prime at the moment.
But it's just, anyway, it's getting high. It's getting high. What do we think? Coming down next year?
Yeah, I think by the end of this year, beginning of next year, they may start cutting rates.
Yeah, I talked to someone last week who really looks into it and has a big group of people, and they felt like it's going to be next year till it starts coming down. I was hoping maybe the end of 2023. He and his group think it's going to be more like 2024 before it starts dropping some.
So it seems like all of the big institutional players in the space have pretty much cleared out from my understanding. And it seems like the deals that are getting done are just like the dirty, gritty guys going in and getting a deal done. I mean, there's no easy, clean cut, good looking properties for sale. You can get that cheap, a seller maximizing on value. I mean, there's a lot of weird stuff out there if you're just looking at existing stuff. Like, why would somebody sell right now? That's the first question you have to ask. Yeah,
I mean, I've seen some clean stuff, a lot of single tenant stuff that's being marketed at 6.5, and there's some 1031 money that maybe needs placed.
Yeah, the single tenant deals aren't worth as much money, right? So a lot of people
smaller,
so people can pay all cash on those.
But anything that has any type of hair on it, that those cap rates are not high enough, and so they're not getting put on the market. We don't see a lot of stuff right now.
I think people are just holding, don't you?
Yeah, everybody wants to know what the feds are ultimately going to do, when they're going to stop cutting rates. Everybody's like, oh, I'm going to wait another 2 months. I'm going to wait another 3 months.
Yeah, buyers and sellers both are just waiting on the sidelines.
Well, still deals are getting done. It's just slowing down. Obviously, with rates continually going up, it will probably slow down even more. But we were able to go down to the Red River ICSC not last week, a couple weeks ago, and surprising amount of activity still being done. I mean, the retailers are still showing up. They're still looking to open locations. We've done several new retail developments in the past quarter. I mean, it seems like there's still activity on the tenant side.
Yeah, the economy is good enough that certain retailers are wanting space, and so they either have to absorb existing space or they've got to find new developments to put their stores in.
Developments don't seem like they've slowed down. At least maybe that's our perspective, because we've really pivoted into those. So in general, it doesn't seem like they have, because like you're saying, retailers are still wanting to expand, and the current interest rates don't impact a development as much as they do on buying a long-term project.
Right. Well, I think that's a decent segue into the topic for today, because today we have, we talk about cap rates a lot. We did it just in the intro when we're evaluating deals and just our small talk and and how we internally discuss deals, a lot of it is the cap rate. What is the cap rate? Because for us, that's kind of a starting point. If we can start at a decent return, we know we can probably go up from there. It's worth digging into enough. But at the same time, cap rate doesn't evaluate everything. It doesn't tell you the whole story. It doesn't assume a lot of things. So you have to evaluate more than the cap rate. You've got to look at something else. So today we're going to go into several topics or several metrics and how you would evaluate a commercial real estate deal like we would.
Yeah.
Well, the first one is always cap rate because it's an easy comparison with a similar vintage.
You're not baiting me into that shit again.
What am I trying to say?
Similar properties in the same asset class?
Yeah, similar asset class in the same market.
Yeah.
The cap rate is the easiest one to be able to try to compare. And so we gain a lot of knowledge off the cap rate. And so that's the first one we use to say, okay, is this deal a good deal or is it not a good deal?
Okay, and here's the question. What is cap rate? Is it a yield on cost expressed as a percentage of the purchase price? I mean, is that accurate to say?
I think a cap rate is technically a value on an asset class in a submarket.
Mm-hmm. No one's going to like that definition, but the one I always want people to hear me say is it's the return you get if you paid all cash for the property, the day one return, not the future value, not the appraised value. It's if I paid all cash, what is my expected year one return? That is going to be close to the cap rate.
Okay, so I think my yield on cost might be accurate.
Yeah.
The downside of a cap rate, though, from what I've seen, is Braden's shaking his head. No, it's not accurate.
It's not a cap rate is not a return, technically speaking.
No,
so you have to distinguish that. Even though I agree with what you guys are saying,
I just said it's an expected year one return if you paid all cash. That's what I mean.
Okay. Yeah, I would agree with
it's
that.
not a return.
It's not a return.
Okay, but sometimes when we look at some operating memorandums and we see a cap rate, sometimes don't people kind of fudge that number and they say, oh, well, this cap rate is based on future.
They want the best of both worlds.
Yeah.
They want the best. So selling a cap rate on a pro forma is basically looking at a discount rate instead or an IRR instead. Because there's assumptions built into that. So how we want to look at it, how you should look at it, is when you're evaluating a deal, you find the net operating income, and then you put the market, submarket, asset class cap rate on that net operating income. So if you pull up CoStar, if you pull up whatever database you have, there's going to be a cap rate for each asset class and each market and submarket in that market. So you may look up and say a retail center in the northern part of Tulsa, Oklahoma, the market cap rate for that today is 8.5. And then you would divide that by your net operating income, and that would yield an estimated value.
Yeah. So negatives on a cap rate, it's just a day one look. It's
the picture.
Yeah. It's not net operating income. I mean, you can calculate it using the cap rate based on today's, financials.
Yeah, just a one-day snapshot, basically, right?
Yeah, but how many times have you bought a $5 million commercial deal and owned it for a day? Never, right? Yeah. So you got to look at more. You got to look at what the property is going to do the rest of the year, what it's going to do in year 2, year 3, year 4, year 5. Does it go down? Does it go up?
Another thing it doesn't do is take into account leverage. And we buy with leverage, and so that doesn't tell you anything about your returns if you're going to leverage that property.
True. Right.
Yeah, it's like looking at, a car value. If somebody said, do you want a 2019 used car or do you want a 2016 used car, you would inherently put more value on the newer car. Mm-hmm. Similar. Right.
Yep.
Okay, so we have cap rate. It's usable, but it's not the only metric we want to look at. What's the next one?
Cash on cash.
Cash on cash, yeah.
Why is this so important? What is it? Let's go. What is cash on cash?
What's the amount of money you put in your pocket, right?
Every year.
Every year.
Cash on cash is the cash flow, the net cash flow coming out of the investment divided by the down payment or the total equity that you put into the deal.
Right.
So like a $100 million building, if we put down 20%, it's $200,000. So I have to take whatever cash flow I have after servicing the debt, after paying all my expenses. Let's say it's $50,000. I have to put that over the $200,000 to get my cash on cash return. In that case, it'd be 25%. Cash
flow usually changes every year, though, right? The percentage a little bit, either based on if
every quarter
CapEx or every quarter. If there was some CapEx expenditure that hadn't been accounted for, or increases in other costs, right?
So
Right.
yeah. Well, I mean, the next question for me is why is this an important metric, and why do we like cash flow? Does that sound dumb? Why do we like cash flow?
Yeah, not all investments have cash flow. If you're doing a development deal or something, you may not have any cash flow. But for us, we love buying cash flow deals because it puts money back in our pocket and in our investors' pocket every quarter. And the higher that cash flow number or that cash on cash percentage, it kind of lets you know how much flexibility you have in your expenses going up or down. If your cash on cash is 6% a year, you can't have much change before you're at risk at zero or negative, having to put cash into the deal to supplement it. But if your cash on cash going into the deal with your assumptions is 20%, well, now you have a lot of room that you can maneuver a little bit with. If something breaks, you've got some cash flow to cover it.
Well, also, we love taking that cash flow and putting it into new deals and leveraging the rate of return on new deals, right? So
I love cash flow because it keeps my phone from ringing. My phone rings when the cash flow stops.
Yeah, well, I'm sure it does.
All right, so negatives about a cash flow. What are some of those?
Well, it doesn't tell you the total.
Doesn't tell you the total return. Doesn't take into account equity pay down. Doesn't assume a purchase price, an exit cap. Doesn't do any of that. It's just telling you what the cash flow you're getting out of it is and what percentage that is divided by your total equity.
Yeah.
For most people, that's a great number, right? Like for most people that don't understand commercial real estate, for most people that are getting into commercial real estate, for our first time investor, if I can get them hooked on the idea that I'm going to pay them 12% a year in cash flow, 10% a year in cash flow, let's call it. If I can pay you 10% a year in cash flow and you don't understand anything else, but you believe you'll get those checks, can we work something out? We're going to pay down debt. That's fact. That's more than 10%.
Yeah, when you think about that, you'd love to get 12% on any investment per year, right? But that doesn't take into account, paying down the debt, increases in rents.
Doesn't mean the investment's ultimately going to hit the numbers you projected, but man, it does reduce your risk. If every year you're getting paid 10, 15%, now 4 years later, you could have 50, 60% of your original investment in your pocket. So if something goes wrong, you're not out the entire amount.
Yeah, right.
So
I just go to like other popular things like Rolexes, Lamborghinis, Bitcoins, the Robinhood app. When's the last time you put 10, 20, 100,000 into anything and it gave you a 10% return the next year?
Yeah.
We have people that do that all the time. Every day.
Yeah.
Every day.
Yeah, most investments, in order to get a return, you have to sell it. And so cash flow allows you to enjoy the return and you still own the asset that's appreciating. Yeah. That's the key that we love about cash flow.
I like that.
All right, number 3.
Equity multiple.
Equity multiple. Yeah. So we see this a lot with private equity groups, family offices. They kind of go on equity multiple. They're not as concerned on when they get their money back, but they're concerned with, am I doubling my money? Am I tripling my money? And we typically see a minimum desire of 2 times equity multiple after 5 years as a minimum. 2 to 3 times cash, as they call it, and a 5-year window is preferred.
Yeah. So I mean, what is that? A 2x equity multiple in 5 years, 20%, right? Roughly.
Approximately.
So that's a great return. That's a great return. Yeah. You have to think about these institutional players, right? Like their purpose in life is to invest money and make money on that investment. But if you give it back to them, that creates more work for them. So they're just like, I want to make money. Let's keep it in that deal. But I only need money back after I get 2 times what I gave you. Don't give me anything before that. Just give me my 2 times and then we'll reallocate it in the next deal.
And the equity multiple is basically your investment plus total cash returned divided by the initial investment. Is that right?
Yes.
That'll give you your
total profit.
1.5 or 2
negatives,
multiple.
The negatives with equity multiple is it doesn't take into account time value of money.
Just really important.
So it's just, you could have a 2x multiple, but you may get 0 cash flow and then you get a dump at the end of 5 years. Mm-hmm. That's not going to be as good as, let's say, year 1, you get 80% return. And then the next 4 years, you get 5% return. Yeah. And then you get nothing at the end of 5 years.
Yeah.
That you'd much rather have the money earlier. They're still, 2x multiple, the same equal on the equity multiple front, but they're very different in terms of total return total average yearly return.
Right.
Yeah, I want to be clear. We're not suggesting that you use one or the other. We're suggesting that you use all of them, right? And here's a perfect example why, just like you just said, you can see a cash on cash number of, year one, cash on cash, 10%, year two, cash on cash, 20%, year three, cash on cash, 40%. Like, man, the cash on cash just keeps going up so much. This is amazing. Well, it's because they're giving you your money back, right? So they're paying out the same cash flow, maybe less cash flow, but it's divided by a smaller number. And your equity multiple, you would see that and you would be like, okay, I'm not really making much money here. You're just giving me a higher percentage return because you're giving me my money back. I don't want my money back, actually. I want my money invested in commercial real estate. That's why I gave it to you. So there's all of these things that kind of make up what investment you like. And I would suggest you have general parameters for each one of these things. When we're looking at IRR, I want an IRR of high teens. We look at equity multiple. I want a 2x in 5 years. When we look at cash flow, I want 10, 12% year over year. And you can start to see, man, this deal's checking all my boxes here. This is satisfying all my needs.
We look at all these parameters, all these metrics on every deal, right? I mean, we don't just look at one.
Yeah, and a good model is going to immediately do that for you. You're going to have your inputs page, shove everything in, and then your outputs.
Spit these out.
Yeah, it's at one time. Exactly.
Right.
Okay, so then we got one more we want to talk about, and that's IRR, which you kind of just alluded to.
Yeah.
And so what's
internal rate of return?
Internal rate of return. It's complicated, but what's the positive about internal rate of return?
So how I would reference it just right off the bat is we said cap rate is like a snapshot or a picture of the return. An IRR I like to think of is a movie. Like it's the life cycle of the deal from the first time you bought it, the day you closed, to the day you sold it. This includes everything. This includes time. This includes profit. This includes cash flow. This includes principal pay down. This includes everything from front to back. It's also the most difficult to get to because it includes everything. There's a lot of assumptions. Yeah. You have to do a lot of work to put in accurate numbers, or else you're just going to get a garbage IRR. That doesn't help anybody.
Yeah, you got to know how long you're going to keep it. You got to know what you're going to sell it for, or at least make those assumptions.
Yeah, and these last two, both equity multiple and IRR, both need to know how long you're going to keep it, and then they need to know what you're selling it for, or assuming an exit cap.
Mm-hmm. Right.
But what I would say is it's taking that total return and it's giving it to you in an average yearly compounding return form. So where the equity multiple is the total amount of money that you're making. I doubled my money. I tripled my money. Mm-hmm. The IRR is, hey, you essentially made an average compounding yearly return of 18%. Woo! That, or whatever it is. That's what this is going to tell you. You get an IRR of 18%. It doesn't mean that you got 18% each year. It just means when you take the cash flows, cash on cash, principal pay down, sale of the property, exit cap assumption, whenever you got, it takes into account time value of money and it puts it into a nice, neat, average compounding yearly return.
Man, I know I got distracted there a little bit.
Yeah, you got a little excited.
I know, but I think sometimes people listen to this and hear us say 18% return and they're like, man, these guys are just picking a number. Like 18% return is so achievable for us. It's not even funny. We could put together a track record of deals we bought and exited that had at least an 18% IRR, and it would just blow people's minds. Most people have never gotten an 18% return in their life, and they wonder why they don't have access to these investments.
Yeah, well, when we used to back when the rates were lower, if we weren't in excess of 20% IRR, we were disappointed. Right.
And we've exited multiple deals at 40% IRR, 50, 70.
Yeah.
Right. So these are not, when we say 18, I mean, that's kind of the single.
Yeah. That's
the single or the double on an investment. It's not the home run.
Yeah.
Next episode, I just came up with the idea. We're going to hit it live really quick. You go to a traditional like life insurance planner and they factor in inflation and like some 7% return in a mutual fund. It tells you how much you need to invest to have your $3 million at retirement or whatever it is. And it just seems so overwhelming. Let's use that same calculator. I've got it. And we'll put 18% on the return instead of this, 7 garbage mutual fund that your life insurance company is selling. And we'll see how much money you have to invest and it will blow your mind. Guys, if you are investing and you're not getting 18%, call us. Please shoot us an email. We've got investments for you. Call us.
Well, let's do that example really quick. I got a calculator on my phone. So let's say that I'm going to pick a number. $1 million is what you need to feel comfortable retiring at 65 or whatever. Okay. And so if you can get 18% return, sorry, I'm going to back up. Let's say you need $100,000 of income in retirement.
Okay.
All right.
Starting at age 65.
Yeah, or whatever. Okay. And so then $100,000 of income, then I have to divide that by what? 0.18?
Mm-hmm. That's how much you'd have to have.
That's $555,000 I'd have to have in savings in order to give myself $100,000 in perpetual income if I could make 18%. Yeah. Okay. But if I want that same 100,000 and I'm only going to make 6% on my money in a safe mutual fund,
you need
$1,666,000.
Yeah.
So you need more than triple the amount.
Yeah.
And so that's a daunting task to say, well, I can't retire until I have $1.6 million. But what if we could show you a way to retire when you got to a $500,000?
Yeah, right.
Well, now you're thinking, okay, I'm not waiting until I'm 65. I might be able to do it at 53.
Yeah.
And so that's the power of getting a higher rate of return. And we've done podcasts on that. Is if you can increase the rate of return, then you reduce the amount of money you need to live the lifestyle that you want, which allows you to quit whatever job you don't like sooner.
Yeah.
Clip that, Aaron.
Yeah. Good idea, Braden.
Clip that, Aaron. I love that.
What else you want us to do, Braden? Come on. Keep it coming.
I think that's it for today.
Yep. We will catch you next time on how to invest in commercial real estate. Make sure to go to the website, thecriterionfund.com, join the investor list, and you'll get all of our investment opportunities. We'll see you guys next week.
Thanks, guys.